Alrighty, let's talk mortgage. Episode number 1. Understanding the concept of a mortgage should be the first step of your home search journey. A mortgage is a debt instrument that a borrower is obligated to pay back with a predetermined set of monthly payments. The mortgage payment is calculated based on 3 variables: loan amount, loan terms, which is the total number of payments, and interest rate. Here's an example of a fixed-rate 30-year loan. With a $400,000 loan amount and interest rate of 3.75%. The required monthly mortgage payment is $1,852. Assuming the loan will be paid all the way through 30 years, the total mortgage payment will be $667,000, which include $267,000 of interest expense. Here are some of the things to consider before applying for a mortgage. Number 1, consider how much can you borrow. Talk with a mortgage professional. He or she will help analyze your current income and liability level to determine your borrowing power. This will help you to put a price cap on how much of a home you can buy. Number 2, analyze your monthly cash flow. Start with your average monthly take-home income. Then, subtract your average monthly living expenses, such as groceries, gas, utilities, phone bills, cable bills, travel expense, entertainment, and other liabilities such as car loan, student loan, child support, alimony, etc. So now, use what's left to budget for a housing expense that you can comfortably and consistently support on a monthly basis. As a homeowner, mortgage payment is only a part of your housing expense. The rest includes property tax, homeowner association dues, standard hazard insurance, earthquake insurance, and flood insurance if necessary. And if your down payment is less than 20%, don't forget private mortgage insurance. Always remember to leave rooms for savings for unexpected expenses and prepare for rainy days. Number 3, down payment. If your down payment is less than 20%, first of all, you're required to buy private mortgage insurance. This leads to a higher monthly housing expenses. Secondly, you will most likely have a higher interest rate as well, which leads to a higher mortgage payment and more interest expenses paid over time. Number 4, your credit score also determines your interest rate. Usually, a credit score above 740 will give you access to the best selection of interest rate, assuming other variables are same. I think choosing a mortgage is really a balancing act between paying as little interest as possible, but without trapping yourself with a burdensome monthly cash flow obligation. Here's a comparison between a fixed-rate 15-year mortgage and a 30-year mortgage on a $400,000 loan. In this example, the interest rate for a 15-year loan is 2.785%, lower than the 30-year mortgage. The total interest expense for a 15-year loan is $92,000, comparing to a $267,000 for the 30-year mortgage. However, the monthly mortgage payment for the 15-year loan is $2,738, which is almost $900 more than the 30-year mortgage. So, how do you choose? Low interest rate or low mortgage payments? Doing a cash flow analysis, understanding your own financial strengths will help you choose a mortgage that provides the most balance for you. So as always, be a smart consumer, do your homework, compare rates, and origination costs. And I recommend you to check interest rate with me. You've got nothing to lose, but so much more to gain. Thank you so much for listening.